Hi, good evening, everyone. I'm Timothy here from PhillipCapital. I'm the product owner for the Share Builders Plan. Thank you all for joining us today on this very hot day. I hope that all of you have had, well-rested long weekend over the Vesak Day holiday. So, thank you for joining us for another SBP webinar, SBP X CSOP, a smarter way to build your real estate portfolio. So without further ado, let me introduce our guest speaker for today, Mr. Adrian Chew from CSOP.
Hi, good evening. Thank you everyone for joining us today. And thank you, Timothy, for the kind introduction and organizing this webinar. It is a precious opportunity to showcase our latest ETF on Singapore Exchange, which is CSOP IH, Singapore REITs Leaders Index ETF, a smarter way to build your real estate portfolio. Now, without further ado, just want to share the agenda and the content of our webinar tonight, right? So why we want to look at the Singapore REITs itself, right? It offers investors very attractive dividend, and also REITs itself potentially has been a good tool to hedge against inflation. Right now, you know that inflation is on the rise, and you know REITs is definitely right now a asset class that we should actually consider investing into, right? And why? And I just want to showcase every ETF have to track an index, and definitely want to share, you know, why we have selected to partner with an index that actually track, you know, Singapore REITs leaders. And what do you mean by leaders, right? We are looking at, you know, out of 42 names, 42 REITs listed on Singapore Exchange, why we only want the leaders, the big boys, right, the large and mid-cap REITs to be on the index and also on the ETF as well, right? It offers investors scalability, right, liquidity, and also diversification benefits. I'm going to share more in details on that. And then, you know, why we launch an ETF, right? ETF definitely is a very popular tool for any investors to have quick and easy access to the real estate market. So this is actually three main agenda that we will discuss tonight. And, you know, by the end of this webinar, you know, I aim to actually give you a bit of a confidence that, you know, amid, you know, the headwinds right now we are facing in the global economy, the macro situation, the geopolitical tension between Ukraine, Russia, and all the perfect storm right now that we are facing, is actually give you confidence to actually be brave and to invest into Singapore REITs itself. Right, and better way is actually to also use a regular savings plan or share builders plan by Phillip Securities to, you know, slowly accumulate dollar averaging, you know, to into this asset class itself. And without further ado, let me dive into the first agenda. Why Singapore REITs right now? It offers investors attractive dividends and yet, you know, a potential hedge against the rising inflation. Right, so I'm just going to touch on some of the big picture. The big picture right now is happening around the world, and why, you know, we have to be upfront, you know, in sharing in terms of some of the headwinds and some of the micro tailwinds for now for the REITs market. And having said that, you know, some of the macro headwinds is that, you know, don't fight the Fed. That is actually the common statement that we hear from the ground and many of the research analysts, right? Don't fight the Fed. The Fed is definitely rising interest rates because why? They're actually trying to fight inflation. After, you know, the COVID-19 and after the great financial crisis, there has been a lot of easy money being pumped, a lot of liquidity being pumped into the market. And having said that, that actually caused a lot of easy money to be made back then. But right now, you know, that actually caused, you know, a lot of inflation, and plus, you know, supply chain disruption and the Ukraine-Russia conflict, you know, has actually pushed up oil prices, commodity prices, energy prices, and that actually add fuel to the disruption of supplies right now, you know, and cause, you know, a tremendous rise in inflation numbers. Right. So what the Fed is going to do is actually going to raise interest rate to fight inflation, you know, including reduction of their balance sheet up to about $95 billion a month, and then more about $1 trillion a year to draw liquidity away from the market. Now, the Fed want the financial condition to be tightened. So definitely it has to be, we have to acknowledge it's definitely going to be a bit of a negative for equities in general. right? So the Fed funds futures right now is actually, we could see that it's actually pricing rates to increase to about 2.7 by end of this year, right? The Fed rates will be 2.7 end of this year, and by next year it will reach a Fed rate of 3.05, right? We do have we do have a luxury to actually meet up some of the research analysts along the for catch up session, right? As the market as Singapore has actually reopened itself, and we believe that that may not be that true. We believe that the Fed may be raised 2 more times of 50 basis points or 0.5% for the next for June and July when the Fed meetings come, and definitely has to hold and wait and see. We believe that actually, even though the Fed futures are actually pricing into that high of a level by end of this year, but the general street consensus is that the Fed might not be that brave or that courageous to be so aggressive in terms of raising to that level. So we believe that maybe another 2 more 50 basis points or 0.5% interest rate hike, the Fed will definitely have to slow down or even stop and monitor the situation, because they themselves do not also want to hurt their own economy, even though they, on the other hand, they have to fight inflation. So we believe that 2 more rate hike is where the Fed would definitely want to take a look at the market situation. Also, we as CSOP also have to acknowledge, right, the global growth right now could slow down, right? Rising rates and the war in Ukraine, plus China lockdown, right? So REITs, we found that REITs is actually more correlated to the GDP growth instead of interest rates, right? Many believe that there's a common belief that interest rate hikes will definitely be detrimental to real estate investment trusts. But on the flip side, we definitely found some of the backtesting data that actually REITs are actually more in line in terms of more correlated to the GDP growth rather than interest rates itself, right? And so the sudden and sharp increase in rates coupled with the continued Ukraine war and the COVID lockdown in China is actually raising a prospect of we're going to expect a slower GDP growth or even a slowdown in the global economy. So these are some of the headwinds that we have to acknowledge. On the valuation, right, valuation side, it looks strange, right? The higher rates definitely we're going to have naturally going to have a higher cost of capital, leading to a lower valuation. So right now it looks stretched, but the valuation will definitely come down again. So right now we have to acknowledge that the rising real rates is actually a big pushback, with the real rates rising quickly, turning positive for the first time since March 2021. This is definitely have to be a strong headwind for REITs market. On the flip side, we definitely have to look on on the bond side when comparing to other asset classes. There's a sharp increase in the 10-year bond yield, increased by 1.25% year to date. This actually resulted the yield spread between the bonds versus the REITs to be falling to about 2.7%, which is actually 2 standard deviation below average. So it might be difficult for Singapore REITs to outperform in this environment. But however, having said that, higher interest rates will definitely hurt REITs' ability to make, yield kind of a accretive kind of acquisition. In that sense, we definitely see, on the positive side, you definitely see more cap rate expansion going forward for Singapore REITs. And on the flip side, we have acknowledged the headwinds, right? We definitely want to look at the tailwinds. Some of the macro tailwinds that we're going to continue to support Singapore REITs is that, for Singapore-denominated assets, we could see inflows from family offices, right? So recently, our Singapore government has introduced new requirements for family offices that's actually based in Singapore. And that there are actually many rich Hong Kong tycoon and overseas tycoon are actually setting up family office in Singapore. And our government saw the opportunity, okay, you can come to Singapore and set up family offices, but you have to at least invest about 10% of your AUM or minimum of 10 million, whichever is lower, in local investment. What do you mean by local investment? Which means listed equities on Singapore Exchange, qualifying debt securities, fund distributed by Singapore licensed fund managers, private equity investments in things, etc. Right? So as we see inflows of family office being set up here, and you know that Lin Ka-shing actually set up a family office here, 10% of his AUM that's actually parked in Singapore, or 10 million, would definitely have to go into Singapore equities. And Singapore REITs is definitely one of a possible tool that family offices will actually invest into. Next is actually the reopening of our Singapore economy, and is actually well underway, right? So offices right now, we have seen the data that the offices are now back to 70% occupancy. And having said that, the retail malls, as you know, we could see foot traffic returning to pre-COVID levels. The crowd is actually returning back to retail malls, be it Orchard Road, be it suburbans. We could see footprints are coming back. Right, hotels, we definitely see starting of inflows. I do observe more tourists recently from visiting Singapore. I see many of tourists lugging their suitcase, checking in and checking out in the local hotels. So we're starting to see a recovery for hotels or hotel REITs in Singapore itself, right? Then we dive into industrial. Industrial demands remain firm, and we expect all real estate subsectors, all the subsectors, to see positive rental growth for full year 2022 and 2023 respectively, right? As I did mention earlier, GDP growth is more important than rising rates for Singapore REITs itself. Right now, we could see that the GDP growth has a stronger correlation with S-REIT performance as compared to interest rates. So Singapore has actually came out and said that the consensus that this year in 2022, right, GDP growth is forecast to grow at 4%. Now, that's of course a decline from 2021, which is actually coming at 7.2%. And last year was actually, we received a lot of supportive measures from the government. Now, as our government slowly withdraw such supportive measures to see whether Singapore economy can support itself, they are forecasting a 4% growth. And that's actually quite a decent growth because this is actually in line with the last period from 2011 to 2018. So 4% is actually the average that Singapore GDP growth from 2011 to 2018. And that's actually a good sign for Singapore REITs as well. So we expect the GDP growth to be positive in Singapore, hence definitely going to be supportive for real estate investment trust performance this year, right? And definitely we have to acknowledge that, right now the global forecast is actually being downgraded due to the war in Ukraine and the continued lockdown in China. These are two main factors. Right, the IMF, the International Monetary Fund, has expected the global growth to slow down from 6.1 to 3.6 for this year in 2022 and 2023 respectively, right? And having said that, this is actually the index performance, right? When people say that interest rate hike is bad for S-REITs, and if you look at the green box right now, once the Fed has announced whatever interest rate they want to impose, that removed the uncertainty from the market, and you could see that actually S-REITs have actually bounced up upon a 25 basis point, 50 basis points kind of introduction to the Fed rate. So actually interest rate hike again doesn't really have any correlation with the performance of S-REITs itself. So let me dive into what is Singapore REITs. Now, REITs itself, the Real Estate Investment Trust, is a company listed as a unit trust that's owned and operate income-producing properties, such as offices, apartment buildings, warehouse, retail centers, data centers, infrastructure, medical facilities, and hotels, right? And a real estate investment trust listed on Singapore Exchange will be generally known as S-REITs. They are being regulated by our local regulators, Monetary Authority of Singapore, under the Collective Investment Scheme regime of the Securities and Futures Act. Now, how is the structure of a S-REIT? Is that, on the exchange, unit shareholders and investors will just buy the S-REITs listed on the Singapore Exchange. And the S-REIT itself owns a portfolio of properties that's managed by a property manager. A REIT listed as a fund is actually being run by a REIT manager, and all the units that the investors buy into the S-REITs are actually being looked after by a trustee. Now, among this chart, what we realize is that is the sponsors. Right, the sponsors it is something that many investors do not understand. Right, the sponsors may own a substantial stake in the REIT and typically own both the REIT and the property itself. And the sponsors play a crucial part in terms of how the success of a Singapore REIT itself, which I will share more in this webinar. Right, so the three benefits of the S-REIT is that when investors holding an S-REIT can enjoy three benefits: liquidity, exposure to the real estate. Right, it is listed as a stock, behave like a stock on the Singapore exchange, so it's easy trading as long as the exchange is opened. And last but not least, investors that invest into S-REITs are tax exempted in terms of the price appreciation and dividend payment as well. Tax exemption on dividend payment and price appreciation. So right, why S-REIT is actually so popular is because of the attractive dividend yield, yet with low volatility. Right, the high and stable dividend income of S-REITs is guaranteed by the Singapore regulation. What do I mean by that? Right, the Inland Revenue Authority of Singapore, of IRAS for short, requires that these REITs managers to pay up at least 90% of their taxable income, which is the rental, to be paid out as unit share to the unit shareholders. Right, so at least 90% have to be given out to us as a unit shareholders as dividend. So this is actually guaranteed by guaranteed by the Singapore regulation, right? And among all the highest yielding dividend yielding product in other asset class in Singapore, you could see that the STI came in at about 4%. A 10-year MAS government bonds it's about 2.3%. The core inflation is about 2.2% for this year. And the fixed deposit rate for Singapore is average about 0.8%. And all these income yielding product couldn't beat the IHS Leader Index, which is forecast to come in a gross dividend yield of 5.3%. So if you look at the yield spread, right, between the 10-year government bonds and the S-REITs Leaders Index is about 2%. If you talk about fixed deposit rate, is about 4.5% yield difference as well. So you can see it's the highest dividend yielding product when you compare to other investment classes as well. Yet, if you would compare the index, the IHS Leaders Index, with other indices regionally, be it Dow Jones Industrial, STI, the Nikkei, the Hang Seng Index, you could see that on this chart on the right, in terms of the volatility, is actually the lowest volatility over a 90-day period, yet offers the highest dividend yield itself. So this is best of both worlds, right? A very high dividend yield, yet a very low volatility. So this is actually two benefits. So there's a reason why S-REITs has been a go-to investment tool for investors. And also, REITs or real estate investment trust is a good hedge against inflation, right? As the economy recovers and start to expand, which is expected to have inflation. And S-REITs could act as a good hedge against inflation based on two reasons. One, rental is a composition of the consumer price index, which is a normal gauge meter, right, to see how inflation is happening. So higher CPI means that it's higher. That means there's higher rental being charged to rentees because the economy is recovering, and higher rental means that higher distribution units to unit shareholders. So that's the reason why, number one reason why S-REITs is a good hedge against inflation. And the dividend yield for S-REITs leaders is expected to rise in the next 2 years at a much faster pace than the Singapore inflation rate. So if you look at the Bloomberg consensus with this chart at the bottom, the Bloomberg consensus is that the IHS REIT leaders 12-month dividend yield is to come in at about 5.3% and 5.4% for full year 2022 and 23 respectively, much higher than the revised core inflation of 3.4 and 2% for the 2022 and 2023 respectively again as well. So you could see these definitely, REITs is definitely going to beat inflation based on the Bloomberg estimates and forecast itself. And we are in the right spot, or we are at the right exchange, stock exchange to trade Singapore REITs itself. It is a growing market that have been attracting fund inflows, and the SGX has been a go-to exchange to list real estate investment trust itself. Right now, SGX is actually one of the largest REITs market in Asia Pacific. 45% of the REITs IPO has debuted on SGX in 2019. And this growing market is going to attract more inflow. And more inflow means it's definitely going to have price support, even price appreciation to the Singapore REITs market itself. And on the average, over an 11-year period, the average growth for the REITs market in Singapore Exchange has been growing annually at 11%. So we are in the right space right now to invest into real estate investment trusts. So looking through the index performance, right, the one denominated in blue, from April to, we did the back testing for 2016 to 2020, right, for this year, April as well. And we found that the S-REITs leaders average annualized return is actually about 8.8% with a volatility of below 13%, outperforming other major global REITs indices, right? And over the last 10 years, S-REITs leaders itself has generated an annualized total return, dividend and price appreciation of 9.2%. And looking through the chart, right, the dark blue line that indicate the index that the ETF is tracking has actually begun to outperform before COVID. But when COVID struck, sure enough, as all markets, it all fell. But you could see that the recovery is so much faster than other global other global REITs indices. So this shows that this has demonstrated its resilience and its recovery strength when compared to other major REITs indices as well. So we have seen such outperformance, and why did the index outperform versus the other major REITs index? It's because as REITs leaders is talking about, it offers investors about the scalability, about the liquidity and diversification benefits itself. Right, just a bit of what is the IHS REIT Leaders Index. It's actually been around longer than the ETF. It has been launched in 2014 March on the 24th. Right now, as of March this year, he has a total market cap of about 68 billion Sing dollars. Out of the 42 names, there are 28 leaders, S-REIT leaders included into this index itself. Right? What do you mean by leaders? Means that they have to be of a substantial size and a substantial trading activity on Singapore Exchange. Right? So the edit, it has to be on the average about half a million being traded on the average, with a trading velocity speed of more than 0.1%. Right? If you meet this criteria and you need to have a certain size on the exchange, right? The free float, which means shares on the hands of the public, has to be more than 500 million Sing dollars being traded on public hands itself. So this shows that if you are a big size as REITs, you are being listed inside and you're actively traded, you're being included into this club, right? Now, I would like to stress the unique selling point of this index. Instead of the traditional market cap weighted index, this use a liquidity adjusted market cap kind of a ranking for the S-REITs itself, which I'll share more in details. This makes the index very, very unique, right? And we kept each S-REITs to about 10% weight within the index. There are two currencies, Sing dollars and US dollars, and we will actually rebalance this on the semi-annual basis in the March and September. So right now, we're about 50% into industrial and data center, which is actually very relevant because due to COVID, a lot of people are shopping online and need a lot of warehousing space as well. So this index is actually very relevant to the current situation. We have about 20 to 25% into office and retail right now, giving you a very decent exposure on the reopening story itself. Right, and this is a sector allocation. Now we dive into the index, into the geographical allocation. 61% is properties within Singapore, while the rest are very diversified into Australia, China, Hong Kong, United States, Japan, and even Europe itself. So in terms of diversification, we have actually very decent exposure in terms of sector, subsectors. In terms of geographical allocation, it's also very diversified as well. Right, so we dive into the first advantage, scale. Why do you want the leaders? Why do you want the large and mid-cap S-REITs to be into this index itself? Right, this is, if you look at the table on the right side, the large and mid-cap S-REITs, which is the quartile one, have actually better risk-return profile in terms of historical returns, in terms of annualized returns, in terms of volatility, average turnover, even on bad situation, the maximum drawdown is actually so much better than quartile 4, which is actually the smallest cap S-REITs itself. So we found that factor backtesting show that large and mid cap S-REITs outperform the REITs market itself and other markets greatly. So that's the reason why we want to track the performance of these large leaders S-REITs index itself. And because of the scalability, because if you are a large S-REITs itself, you're able to acquire property easily, right? And you have a larger market cap, and then you have a more stock liquidity that give you higher valuation. And with higher valuation, you're able to raise equities cheaply to acquire more properties. So there is a virtuous cycle in the importance of scaling up, right? And this is very important. Getting back to the sponsors, right? Why sponsor is so important? Because there are many government-linked sponsors with experienced managers backing these large and mid-cap S-REITs, and that's the reason. One of the reason why these leaders index outperform the market itself, right? And with government-linked sponsors, right, and you are big in size, you have easier access to quality, newer, well-located, and dominant assets globally, right? Again, back to the virtuous cycle of actually buying good, well-located properties. So that you can see that virtuous of being a large government-linked sponsor S-REITs itself. And with size, definitely we reach kind of operation efficiency that comes with scale, right? With strong sponsor pipeline, give you a better global outreach to acquire better properties itself. Now, if you're a big boy, you are able to have a yield spread advantage. What do you mean by that? You're able to negotiate with lower costs, even though with rising interest rates, you're able to negotiate. You have to fight, you have the muscle to negotiate, lower costs for equities and for in-depth and for interest to be charged onto you because you're a big boy. Hence, you have a better profitability, right? And that also lower the return hurdles to acquire for more properties itself. So that's the yield advantage of the large and mid-cap S-REITs itself, right? So having said that, S-REITs has seen a rush to acquire property overseas because right now Singapore market is saturated. So having said that, local market is saturated, these big boys have the advantage due to the government-linked sponsors to actually acquire quality, better, well-located, dominant assets itself. So this allows the S-REIT leaders to scale up rapidly to compete globally for quality assets, to diversify, geographical and sector exposure, right? In that sense, also achieve greater trading liquidity, have access to a wider pool of investors, and that definitely will help the share price of these large and mid-cap S-REITs. The second advantage is the liquidity advantage. The index tracks the most liquid representation of the S-REITs markets itself, right? At every rebalancing, this statement is very important. And every rebalancing in March or September, we will rebalance based on a liquidity enhancement. What do I mean by that? Right. So again, over the last, if you look at the daily traded velocity, right, of 0.1 or more. So if you are very actively traded between the rebalancing, you have an adjustment factor of 1. That means you've been the last 6 months you have been actively traded. So you have a higher rebalancing factor. Those that has been very low trading volume would have a lower trading adjustment factor. So what do I mean by this? Take for example, right, in September last year during the rebalancing, the trading velocity for Suntec REIT is coming at 0.9%. That is actually 9 times higher than the daily 0.1%, right? So this means that a lot of investors are looking at Suntec REIT. It could be, right? Investors are looking at Suntec REIT riding on the potential reopening story. Potentially, there is many research reports saying nice things about Suntec REITs, and there could be a sector rotation to Suntec REITs, right? And having said that, so he goes into the 4th quartile, which means it's actually the top trade, the most liquid S-REITs for the last 6 months. So before the rebalancing, the Suntec has only about 2.88% market cap weight of the index itself. Now, because it has been actively traded for the last 6 months, they have a higher adjustment of 1.35% to come in at to have a final total weight of 4.23%. Right? CICT, Commercial Trust, right, have about 5 times more than the daily traded velocity. Unfortunately, he actually hit the 10% market cap weight cap already. So there's nothing to be done as a portfolio manager or a fund manager like CSOP, right? It stays at about 10%. Now, the Capital DC REIT data center, right, has been actively traded as well. Before rebalancing, it was about 5% weight, right? Increased 2.3 or 2.4% weight to settle at about 7.5% weight to the market cap, to the index itself, pardon me. Maple Logistic, Capital REITs itself also have been actively traded, so that they bumped up their market cap index weight higher, right, to reach at about 10 and 4.9% respectively. On the flip side, right, MUST, and OUE Commercial Trust has been lowly traded, right? No one's just looking at these REITs. So we definitely will actually readjust lower for these REITs that has probably no one looking at them as well. So MUST, Manulife, right? REITs, we have a over 2% weight. We actually reduce the weight itself to actually below 1% itself. So what does it mean is actually at rebalancing, we look at which are the REITs that has been actively traded over the last 6 months. This reflect the sector rotation, the fund flows, and the interest from investors. These make the index very robust and smarter to track, have to increase exposure to the subsectors of the REITs to give a better representation of the current market situation. So it's not like a traditional, if you're a big market cap, you have more weight to the index. That's a very traditional way. By looking at this liquidity enhancement, it helps to track, fund flows, sector rotation, make the index more representative to the current market situation, right? This gives the investors the right, potentially the right exposure to the right sectors based on the current market situation, right? And this also, one thing is actually the bid and ask spread, right? Investing can provide a narrow bid and ask spread and lower trading costs than a single REITs by trading in securities, right? So what I mean by bid ask spread, if you go in bid ask spread, if it's, let's say it's about 0.57%, that will eat up your total return when you exit your investment. So if you go into investing into an ETF, not only giving you a diversification benefits, it have a tighter spread. So that means you go in and out, you're paying a lesser spread, which means that it helps to improve your total return when you exit the investments. Actually, next is actually also diversification benefits, right? With the index not only includes, cyclical REITs like, the retail REITs and office REITs, which is about more than 20 to 30, 25% weightage, but also emerging REITs that are actually benefiting from the new economy. As I mentioned, industrial, which includes warehouse REITs as well, and data center has accounted nearly 50% of the exposure. This gives investors, 50% exposure into the new economy, which is, being sprouted out from the COVID-19 that happens last 2 years ago, right? So you could see that this index provides sector diversification and geographical diversification as well. Right, and through diversification advantage, it provides stable return versus a single REIT securities. Now, if you look at the maximum drawdown for the large cap Maple Logistic, CICT, Maple Industrial, and Ascenders, right? You could see that sometimes the maximum drawdown could be over about 30%, over 30%. There's actually something that maybe investors could not stomach, right? But by buying an ETF, right, investing in index itself, the maximum drawdown is actually pretty much cushioned, as it has actually helps to cushion during drastic market situation. So to summarize, what's the benefit of the IHS Leaders Index? You could see that over the last 5 years, it has a better performance versus the other global REITs indices as well. The key thing is that the liquidity adjustment strategies that follow fund flows and sector rotation, right, especially into REIT sector that has been attracting new capital inflow consistently, this liquidity adjustment strategy give investors, the right exposure that better represent the current situation. Right, lower volatility compared to investing into individual REITs or other REITs index as well. Right, so by weighting towards the large and mid-cap S-REITs through a liquidity adjustment strategy and cap at 10% weight, you could see that the large and mid-cap S-REITs has outperformed, the smaller cap S-REITs over the last 10 years. Right, this result that the large and mid-cap S-REITs have a larger weight in the index, giving investors the right exposure to the right sector and the right stable dividend yield, diversification benefits, right on the benefits of their scalability itself. So these are some of the benefits why IHS Leaders Index. So why you should consider investing through CSOP S-REITs Leaders Index? This offers investors an easier access to the real estate market. Right, so just maybe allow me to go through the funds specifics of our ETF. Right, we have an AUM about 18 million as of April this year. We adopt a full replication strategy. This means that we do not enter in derivatives or swaps. We buy the underlying S-REITs. It's backed by physical shares of the REITs markets itself. Now, there are two currencies listed on Singapore Exchange. With the ticker of SRT, that is our Sing-denominated S-REITs ETF. And we have the ticker of SRU, that is our US dollars denominated S-REITs itself, right? Both tickers are fungible. That means if you you have some US dollars spare cash, and you could actually invest using US dollars. But if you have needs for Sing dollars, you can sell into the Sing dollars class, vice versa, right? So both counters are fungible, right? And the base currency, of course, is Sing dollars, right? And our lot size is actually $1, 1 unit itself. And we are committed to distribute dividends semi-annually, and will be given out in Sing dollars only. As is a full replication strategy ETF, this is an excluded investment product or EIP, which means that you do not have to declare your trading experience or your education. You can just log into a Poems and then just click to buy this ETF, right? Now, the important thing is that we kept the total expense ratio of this ETF at 0.6% cap, which means that you know that the total cost of owning this ETF and getting access and diversification benefits to you as an investor is kept at 0.6% annually. Anything above that, we CSOP will bear the cost, and we will absorb the cost. We will not transfer it and pass it on to the unit shareholders. We would actually absorb it. All right. So this is actually a key takeaway. Cap at 0.6%. That is your maximum cost for a year by holding on to this ETF to actually enjoy the benefits of the IHS leaders itself. Right, so giving you an easy access to the real estate via the ETF, right? So if you compare a single REIT, a physical property, and owning our ETF itself, so through our ETF, you're owning a basket of high quality, large and mid cap S-REITs with revenue exposure from various industries, subsectors, and globally, right? So you're so diversified and having a basket of high quality, large and mid-cap S-REITs itself, right? In terms of cost and convenience, it's very easy to trade as it's listed as like a stock on Singapore Exchange, low investment threshold, low ongoing cost of 0.6% cap, and low transactional cost itself as well. Right, a tighter bid-ask spread of the IHS REIT Leaders Index at 38 basis points will actually help you in terms of a total return when you exit it. Right, give you diversification benefits. It eliminates the single security risk itself. Liquidity is definitely highest when you're comparing to a S-REITs and a physical property itself. Very transparent, and you know that you're buying the big names, 28 large and mid cap S-REITs itself. Right, dividend yield for physical property is only about 3%, right, after tax. And for us, you definitely stand to benefit stable, sustainable dividend payment. We're expecting about 5.7, 5.3 to about 5.4 as of Bloomberg estimates for the full year for 2022 and 23 respectively. Now, the beauty of it is actually, if you would hold a property, we definitely have 10% property tax. But as an individual, if you were to invest into this ETF, right, tax exempted in terms of a dividend, right? You pay no tax for your dividend income through the ETF itself. So the time is actually to invest into the S-REITs reopening right now. If you look at right now in the chart, since the November listing of our ETF, right, you could see that the blue line and the white line is actually our ETF. And we could see that right now it actually has been performing really, really well against our local indices itself since the listing itself. And what I'm trying to say is that yield is not the only story that investors should look at. And that is actually a personal sharing that I want to share, because I used to invest, oh, this is the highest yield, I just want to buy into the individual REITs itself. And many of the times the higher yield means that, the company is giving you a lot of dividend, and potentially there's a low share price and higher dividend, just to keep the investors happy. But most of the time, higher yield, with low share price, most of the time, when bad market situation, definitely go belly up. So I just wanted to share my story that yield is not the only story that you should look at, but you also should look at which of these REITs give you higher potential for capital appreciation as well, right? So this is called the annualized total return. And you could see that the underlying of our ETF have been offering the highest historical returns and highest expected dividend yield, yet with relative stable low volatility, right? So look at the expected dividend yield is about 5.7, and you look at the annualized return over a 5-year period is coming at 6.3%. So we want investors not only have very stable dividend yield, but also a higher potential for capital appreciation as well. We do not want, to invest into something that just give you a yield, but there's no price appreciation. Definitely, the large and mid-cap S-REITs, which has been very attractive, and not only attract retail investors, they also attract institutional investors as well. So that helps to support the price appreciation of these large and mid-cap S-REITs itself. Right, so it has been, like Deep mentioned, it has been a top SGX listed S-REITs since late November itself, and it actually been very resilient, be it the Ukraine-Russia conflict or the interest rate hike. It has actually performed relatively well due to the fact that it's actually tracking a basket of large and mid-cap S-REITs that provides investors resilience, price resilience amid uncertain times as well. So having said that, I'm reaching the last slide of my webinar. Just want to give you some of the key takeaways. On one side, the IH S-REIT leaders is tracking large cap S-REITs and mid cap S-REITs. The large cap S-REITs, offers investors the access to quality assets, stronger sponsorship and management, and riding on their economies of scale, because you're a big boy, you're able to negotiate, you have muscle to negotiate. Even though interest rate hiking, you have the muscle to negotiate better terms itself, give you a higher yield spread advantage. They offer you growth in terms of price appreciation and liquidity itself. On the flip side of the scale, the mid-cap S-REITs offer a very higher dividend, stable cash flow, give you a sector diversity and better representation of the S-REITs market itself. You funnel these two benefits into the CSOP IH S-REIT Leaders ETF, give you a smarter way to build your real estate portfolio based on 6 reasons. Cost and tax efficiency. One trade, you're actually buying into the large and mid-cap S-REITs. Tax, in terms of tax efficiency, you as investors buying into it, there is no dividend. There is no tax on your dividend itself. So that's is a benefit itself. Just want to stress, being different from the traditional market cap weighted index, we use a liquidity adjustment rebalancing, right, to track fund flows, investors flows, especially into the REIT sector that has been consistently attracting new fund flows into that sector. And we will rotate based on that, so that to give the index and the ETF and the investors that invest in this ETF to have better exposure to the current sectors that actually better represent the market situation. Very attractive dividend yield, 5.3 and 5.4 for full year 2022 and 23 respectively. Diversification benefits in terms of geographical and sector allocation, very stable asset value because they are large and mid-cap S-REITs itself. And looking through, they have actually very low turnover, very low trading volume turnover, and also lower volatility when you compare to other REITs indices and other traditional index as well. And with that, I'll hand the floor back to Timothy for his part. Thank you so much. Timothy, to you.
Thanks, Adrian. Wow, what a great sharing. Hold on, yeah. Let me just share my slides.
I'll stop share right now. Yes.
Okay. Sorry, hold on. I seem to be experiencing some technical difficulties. Okay, so wow, Adrian, thanks so much for the sharing. I can't help but feel a sense of nostalgia that when you mentioned that borders are opening, more foreigners are coming in. I think I can speak for many people, that the pandemic is almost coming to an end. So,
Yep.
I mean, if any of you, of our viewers here today, are looking to add CSOP, the S-REIT Leaders ETF into your, to diversify your portfolio, to add this ETF into your investments, you can sign up and subscribe through the Share Builders plan, where you can utilize dollar cost averaging, and you can just scan the top QR code over here. So and the second QR code is for the gyro form. Do note that for the gyro forms, due to banks regulations, we require the original copy. Yeah, so you can just input your investment instructions when you sign up for the Share Builders plan, and then you can send the gyro form to us at this address, or head down to any of our Phillip Investor Center and just pass it to our counter, and they will pass it to us. So currently we have 2 ongoing promotions. For new Share Builders plan subscribers, we are having a 3 months handling fee rebate. And for if you want to build your portfolio for your children, right? New junior Share Builders plan will get 12 months of handling fee rebates. So you can scan this QR code. You can visit our RSP POEM's website for more information and more details. So with 8 minutes left on the clock, we believe we can take some questions now. And I saw a few questions earlier from David Ng. So I think Adrian, would you like to take on this question?
Yes. Yep. So there's one. Is it possible if I could go back to screen in terms of
Sure.
help in terms of? Thank you. Yep.
Hold on, yeah. Let me stop sharing.
I got it back. I think I got it back.
Okay.
Thank you so much. Yes, so Mr. David, does this fund pay money dividend, and what's the expected return? So we can't say what's the expected return, but we give out the dividend on a semi-annual basis, which means that probably in June and in December we would give out the dividend to unit shareholders. In terms of expected return, we can't say how the expected return would be, but it seems like Bloomberg estimates is that for this index, full year 2022 and full year 2023, the gross dividend is about 5.3 and 5.4% respectively. So let me type in the answer for you. Dividend is actually on a semi-annual basis. And Bloomberg estimate 5.3 and 5.4 dividend yield for this year and next year, for 2022 and 2023. Yes, so how is the NAV performance for the past 2 years? But we do not have the NAV right now, but if you look at the index performance, it has been doing pretty okay versus the rest of the other indices as well. So if you look at the blue line, this has been the index performance, and it has been doing fairly well against other indices. All right. I think there's one more chat. What's the ticker code for this ETF? Right, so the ticker code is actually for SRT, is our Sing denominated ETF. Right, Timothy, correct me if I'm wrong. The SRT is actually is the one that's actually on the Share Builders plan, right?
Yes, correct. The SRT.
That's right. That's right. If you want to trade with the SRU, that's our US denominated. Yes. So there's one question from, with the Fed and the market confirms more rate hike, should we hold entering if we want to time the market? Now, timing the market is something that is really difficult to master. Even though I was a market maker and a trader previously, it was so difficult to find the bottom itself. And taking a leaf off the page of Warren Buffett is more like the time in the market is essential rather than timing the market. So one way is actually through the regular savings plan that Phillip offer, right? By dollar averaging, as the market goes down, you're actually, with the same dollar value, you're actually getting more units. You're buying more when the price is down. And to take comfort from it is actually, this is backed by real estate, and this is considered a dividend paying kind of REITs itself is actually a dividend paying kind. It is better to buy and hold and buy into dips rather than right now. Is interest rate hike definitely going to hurt the growth sectors, but I think buying into the dip for dividend paying asset class, it's actually might not be a bad idea as well. So I think with the interest rate hiking, and we show that every time the interest rate hike, that the market actually recovers, is something that we could consider building our portfolio going forward. Yep. Yeah, I think let me look for a chart where there's an interest rate hike. Right. So this is a chart, right? So this little gray box, when the Fed hike the interest rate, the market actually recover, right? So that could be a sign that with every interest rate hike, once the announcement has been announced, uncertainty is removed from the market will definitely rebound based if the data hold true. Yeah. Yes, so there's one Peter. Yep, yeah, I bought this last offer at $1, have lost money. When can it recover? That is a crystal ball that I wish I would have, but I also have invested. I have actually practiced what I preach in terms of when the market dip, buying into a index, a dividend paying investment, helped me to actually build my retirement nest, and also getting entering a fair value, getting at a better price itself, right? So when can it recover? I believe this is a question that I hope to have the answer to, but we believe that all this will pass as well. Yep. Thank you, Mr. Peter. Yep. So there's one question from David Chong. How has a property impact by conflict performance? Well, I think recently there's an announcement that came out that even though the property prices are still going up with like government regulations and everything, it seems like real estate is something that is actually very resilient amid uncertain times. Rental has been growing, price has been going up as well, even though ABSD has gone up from 12 to 17%. So I think it has very little impact in terms of Singapore property. Yeah. Right, Timothy, I believe I've answered most of the question, yes.
All right, sure. Thank you very much, Adrian. I think the question asked by the anonymous attendee on the timing the market, right? Really, it comes very close to heart when it comes to dollar cost averaging, right? So by dollar cost averaging, you actually take the emotion out of investing, right? So unfortunately, due to time constraint, I'm unable to share more on the share builders plan. Perhaps for those of you all who would like to find out more, you can either head to our RSP website, which is over here. You can contact me at rsp@phillip.com.sg. You can call into our hotline. You can visit our RSP website to find out more about the share builders plan. In fact, recently on our market journal from Poems, we have actually posted up an article on taking emotions out of investing. So it really takes out the panic when prices drop and rise drastically, and you know, it helps you take the emotion out of investing so that you can constantly dollar cost average your investments. So it's 7 o'clock now. I want to thank you all for joining us today. Thank you, Adrian, for your wonderful sharing.
Thank you, Timothy.
I hope you all have a wonderful dinner ahead and have a great rest of the week. So we come to the end of the webinar. Thank you so much, everybody. And I hope you all have a good day and a good week ahead. Thank you. Bye-bye.
Thank you. Thank you.